So the adjustments discussed so far, stock-based compensation, other non-cash items like amortization expense, and non-recurring items are so common for some industries that companies increasingly align their presentations and disclosures to facilitate this analysis that we've been talking about, of basically ignoring these items. Now, companies are not allowed to deviate from GAAP-based presentation in the core financial statements. You can't just exclude these items from your income statement. GAAP doesn't allow you to do that. But what companies can do is provide additional non-GAAP schedules and provide non-GAAP future guidance. In fact, management guidance is typically presented on a non-GAAP basis, with guidance for expenses and earnings per share excluding things like stock-based compensation and unusual or infrequent items. And in parallel, analyst consensus earnings per share estimates. When you try to understand what is the analyst community's consensus EPS expectations for a business, those EPS consensus estimates are usually communicated on a non-GAAP basis. The quote-unquote real numbers that analysts are thinking about are the numbers that have been adjusted from the GAAP figures to the non-GAAP figures. And quite often, specific industries have their own additional and unique non-GAAP conventions. For example, the real estate industry looks at non-GAAP conventions in terms of how to calculate profit and things of that nature. Other industries, whether it's financial institutions or oil and gas businesses, all have their own additional and unique non-GAAP types of conventions. Now, one of the challenges with these non-GAAP presentations is that there is no uniform presentation of these items on the income statement. Press releases and conference call transcripts are usually the best places to look for these non-GAAP presentations. Management often provides analyst-friendly presentations and disclosures in both of these platforms when they're communicating their quarterly results. But also in the 10K and 10Q, there are often aggregations of non-GAAP data within major expense categories like cost of goods sold, SG&A, operating expenses, and that may or may not be disclosed in the footnotes. So in terms of where to find these non-GAAP presentations, probably the most likely places, since they're not required, there's not a place you're always going to find it, but most of the time it's going to be in the press release. There's going to be some more color provided in the associated conference call transcript. And then in the 10K and 10Q, there will likely be disclosures. If they're explicitly communicated in the press release, they're most likely going to also be communicated, but not always in the 10K and 10Q. Remember, the difference here is you're not required to communicate anything non-GAAP. So here we have a company called VMware that has provided, as part of their year-end press release, a full reconciliation of what their GAAP-based income statement looks like. And this is, you see, they have revenues of $5 billion, operating income of $1 billion. And you see that they're making a whole bunch of adjustments. These columns between GAAP and non-GAAP are a whole bunch of adjustments to the GAAP-based financials to get to what non-GAAP looks like. So before we go into some of these line items, let's actually take a step back and see that GAAP-based revenues of $5.2 billion are the same as non-GAAP-based revenues. It's actually quite rare that there are going to be non-GAAP adjustments to revenue. Everything we've been talking about is the exclusion of certain expenses and certain non-operating income items. So this is pretty consistent with what you typically see, that there's not going to be any adjustments on the revenue side. But once you get to the expense side, let's take a look at just cost of goods sold, for example, cost of license revenues and cost of service revenues. While the company reported GAAP of together something around $730 million, there's a whole bunch of adjustments down from 210 and 520 to 84 and 488 associated with various activities. So one activity is stock-based compensation. Notice this company excludes stock-based compensation expense from all of the line items where stock-based compensation expense is recognized. But then there are several other adjustments. Intangible assets amortization, this is that non-cash amortization expense we talked about, was buried within cost of goods sold. It's being excluded. And then you have several other adjustments here that are specific to VMware. We talked about some of the most common ones, and here you see them being reflected. If you scroll down, if we go to the next slide, you'll see that moving beyond operating income all the way down to net income, there's a whole bunch of other adjustments. For example, other income. So the company reported GAAP-based other income of 28. Well, actually, virtually all of that is and considered an unusual activity because it's tied to the gain on the disposition of an asset. It's considered a gain on the sale of an asset. And from a non-GAAP perspective, we don't want to look at gains. And so the non-GAAP adjustment is actually a loss. We're actually looking at an other loss. So it changes the resulting profitability. So if you look at this company, they had income before taxes on a GAAP basis of 1.1 billion. It's actually 1.8 billion, far better on a non-GAAP basis. And that's pretty common. Actually, managements often will present their non-GAAP financials in a way where the net result is that their operating profit is much higher than it would have been on a GAAP basis. Companies are much more likely to want to highlight non-recurring expenses than they would like to highlight non-recurring income. And there's quite a bit of subjectivity about what you choose to identify as non-recurring. So the last adjustment here is income tax provision on a GAAP basis is 133 million. But because we've excluded so many expenses, we need to actually bump up taxes to what it would have been had there been much fewer expenses. So that's the catch-22. If you're going to basically exclude what looks like between GAAP income before taxes of 1.1 billion and non-GAAP 1.8 billion, that's about $650 million worth of expenses, net expenses that the company is ignoring. Most of them, notice, is coming from stock-based compensation. There's about $460 million worth of stock-based compensation that the company is ignoring. That's the big driver of this. Well, if you're going to pretend like you don't have stock-based compensation expense, you should pretend like the tax shield associated with that, as well as intangible asset amortization, some of these other items, doesn't exist either. And notice that the net result is, while on a GAAP basis, diluted EPS is $2.34, on a non-GAAP basis, it's significantly higher, $3.37. And that is the essence of why this becomes so important. The way that analysts and companies communicate about the performance of the company under question is very much on a non-GAAP basis. And so understanding these adjustments is crucial to understanding why it is when you pick up a company's 10K or 10Q, the EPS that you see and the operating profit you see is very different from the actual operating profit and the EPS and all the metrics that the analyst and investment community is talking about. It's because of these adjustments.